In 2014, Facebook bought WhatsApp for $19 billion.
Which is just a staggering amount of money.
Right. And at the time, WhatsApp had just 55 employees and like almost zero revenue to speak of.
Nothing.
So if you were to sit down and use traditional textbook asset valuation formulas, looking purely at their servers and office furniture, the company was worth absolute pennies.
Almost completely. Just the scrap value of the laptops, basically.
Exactly. So how on earth did the investment bankers and corporate development teams justify a $19 billion price tag to their board of directors?
Well, welcome to the dark art of valuation.
It really is, isn't it? It's like this ultimate corporate magic trick.
It is. And, it is the exact reason why valuation is so incredibly daunting for anyone studying it. I mean, we all want the comfort of physics.
Sure, we want a clean formula.
Right. We want an equation where you input the mass and the velocity and out comes a single undeniable number. But corporate finance doesn't operate in a vacuum. It operates in the messy, irrational, deeply subjective real world.
Which is exactly who we are talking to today. If you are listening to this, you are the learner.
The one in the trenches?
Yep. You are likely an MBA student. You are staring down the barrel of a brutal corporate finance exam. Or, maybe you are just trying to master the mechanics of mergers and acquisitions.
And you probably have a textbook chapter in front of you that is dense, intimidating, and, let's be honest, filled with a dozen different formulas that seem to contradict each other.
Oh, constantly.
Yeah.
So our mission for this deep dive is to rescue you from that textbook. We are going to transform those rigid equations into, like, a mental toolkit.
Right, because we aren't just going to memorize formulas. We are going to dissect the mechanisms behind them.
Because when you sit down for that exam, rote memorization will completely shatter the moment a professor throws you a curveball.
And they always do.
Always. But if you understand the economic logic, the actual underlying why, you can navigate literally any scenario.
Absolutely. And to build that toolkit, we have to follow the logical life cycle of how value is perceived. Think about the progression. We begin with the most conservative baseline, right?
Which is what?
What a company physically owns right now, historically.
Yeah.
That gives us our asset-based valuation. But companies aren't museums.
Right. They're just sitting there.
No, they are machines designed to generate cash. So we transition to looking at what the company pays out in the present, using yield models.
And then from there, we have to look forward. We pull out the crystal ball to evaluate what the company will generate decades into the future using discounted cash flow models.
The famous DCF.
The holy grail.
Yeah.
And once we have a grip on the mechanics of cash, we have to layer on the academic theories, the heavy-hitting, Nobel-winning models that dictate how markets price risk and structure capital.
Like CAPM and Modigliani-Miller.
Exactly. And then finally, we bring it all back to the trading floor to look at fundamental multiples, like the actual shortcuts investment bankers use to price deals in real time.
So it's a journey from the tangible past to the operating present, to the speculative future, and finally to, market reality.
To give you a mental anchor for this entire deep dive, I want you to think about valuing a business like buying a used car.
Okay, I like this.
Right. If you are trying to price a vehicle, you have a few different methodologies. You could drive the car onto a scale, look at the current commodity price of scrap steel, aluminum, rubber, and just price it based purely on the physical materials it is made of.
So that is your asset-based valuation.
Exactly. It's the absolute floor. But alternatively, you could look at that same car as a working taxi cab in a busy city.
Oh,
You don't care what the bumper is made of. You care about how much cash it collects in fares every Friday night.
And that is your yield model.
Spot on. Or you completely ignore the metal in the fares and you just walk down the street to see what 10 other identical cars sold for on the lot yesterday.
Which is your multiples valuation.
Bingo.
And the crucial takeaway for an MBA exam is that none of those methods are inherently wrong.
Right. It's all context.
Exactly. The context dictates the tool. I mean, if a business is bankrupt and being liquidated, you need the scrap metal approach.
Yeah, because there are no future fares.
But if it is a hostile takeover of a highly profitable going concern, you need the taxi cab approach.
Makes perfect sense. But before we can even pick up those tools, though, we need to know what we are actually applying them to. We need to define the boundaries of the entity we are valuing.
Oh, this is a big one.
Yeah, and in corporate finance, the very first trap you will encounter is the difference between valuing a single equity share and valuing the business as a whole enterprise.
Yes, this distinction is where so many points are lost on corporate finance exams. We really have to separate the concept of a single slice of the pie from the concept of the whole bakery.
I love that. The slice versus the bakery.
Right. So share valuation is simply the process of assigning a monetary value to one single equity share. For an unlisted company, the textbook gives us a starting point. The value of a share equals the shareholder's equity divided by the number of outstanding equity shares. It's just an accounting reality.
And if the company is listed and publicly traded, well, the market does the heavy lifting for you. The total value of equity is simply the market capitalization.
Which is just the current share price multiplied by the number of outstanding shares.
Right. But that is strictly the equity side. It is just the shareholder's piece of the pie. The textbook then broadens the lens to the value of a business and states that this requires looking at the entire capital structure.
This is where it gets tricky.
Yeah, the formula provided is value of business equals value of equity plus less value of debt plus minority interests plus less as pension and other claims.
And this is the concept of enterprise value. It requires a fundamental shift in how you view a company.
How so?
Well, you are no longer looking at it from the perspective of a stock market investor who just owns common shares. You are looking at it from the perspective of an acquirer who is buying the entire operation.
Okay, let's push back on that logic for a second, because this is where the intuition breaks down for a lot of students. Why on earth do we add debt to find the value of a business?
It does seem counterintuitive.
Right. If I am evaluating a company and I see it owes like $50 million in long-term debt, that feels like a massive negative. It feels like a burden that should subtract from the value, not a premium I add to the total.
I know. It is the classic paradox of corporate finance. Adding a liability to find a value feels entirely backwards. But think about buying a house in a competitive real estate market.
Okay, I'm with you.
Let's say you negotiate a final purchase price for a house at $500,000. That is the true negotiated market value of the physical asset. However, the current owner has a $400,000 mortgage on that property.
Okay, so when we go to closing, I am not handing the seller $500,000 in cash. I'm taking over the $400,000 mortgage, and I'm only writing a check for $100,000 out of my own pocket.
Precisely. That $100,000 check is the equity value. It is what the shareholder of the house actually paid in cash.
I see.
But if you tell your friends, I bought a $100,000 house, you are lying.
Right, because it's a $500,000 house.
Exactly. The enterprise itself is worth $500,000. It just happens to be funded by $100,000 of equity and $400,000 of debt.
That clears it up so well.
When a corporation acquires another corporation, it is buying the assets. And to acquire those assets, it must either pay off or assume the claims of the debt holders.
Because the debt holders finance the factory just as much as the equity holders did.
Exactly. Therefore, to calculate the total capital required to replicate or purchase that business, independent of how its previous management decided to finance it, you must add the equity and the debt together.
The debt is just a different flavor of funding for the exact same underlying asset. Capital structure neutrality. That makes perfect sense. So for the student listening, your mandate for the exam is this. Read the prompt carefully. Does the question ask for the value of equity or the value of the business?
Crucial difference.
Because if it asks for equity, you are solving for the $100,000 check.
Yeah.
If it asks for business value or enterprise value, you must add that debt back in.
Right. And having established whether we are valuing the slice or the bakery, we can start deploying our methodologies. So intrinsic value gives us our rock bottom baseline. Let's explore the asset-based valuation method.
Okay, let's go back to our used car analogy. This is the pure garage sale approach.
The absolute floor.
Yeah. We are abandoning the future. We are stripping away the going concern premium. We are looking strictly at what the company physically holds right now. Like if the board of directors locked the doors tomorrow, fired everyone, and held a massive liquidation sale, what cash would be left for the equity holders after paying off every single outside creditor?
It is the most brutal, conservative model available. You assign zero value to hopes, dreams, market dominance, or brilliant management.
None of it matters.
Nope. The textbook formula is austere. Intrinsic value of an equity share equals net assets available to equity shareholders, divided by the number of equity shares.
The denominator is easy, but the numerator, net assets available to equity shareholders, is a minefield of accounting rules that examiners love to test.
Oh, we love it.
First major rule, net asset value, is based on the historical value of an asset. Cost price less depreciation. You do not use the current market replacement cost unless an accounting standard explicitly allows a revaluation.
And we have to unpack the mechanism behind that. Why historical cost? Why not what the asset is worth today?
All right, why not?
Because historical cost is objective and verifiable. You have a receipt. In an intrinsic valuation, if you allow management to constantly mark up the value of their real estate or their machinery based on current market conditions, you open the door to Enron-style accounting manipulation.
Oh, yeah. Management will always claim their assets are worth more than they actually are.
Exactly. Historical cost forces you to stick to the auditable past.
Next rule. Only external liabilities are to be deducted. These are claims payable to third parties on the date of valuation. Bank loans, accounts payable, bills payable.
And crucially, you have to deduct preference shareholders' claims.
Right, because preference shares sit higher in the capital stack than common equity in the event of liquidation.
Correct. But you completely ignore internal reserves. General reserves, retained earnings, profit and loss account balances.
And why is that?
Because those pools of capital technically belong to the equity shareholders already. They aren't money owed to an outside party. They are just equity wearing a different accounting hat.
I like that. Equity wearing a different hat. And then we have the final rule, which is the ultimate reality check for modern businesses. The value of intangibles is completely ignored.
Oh, this one hurts.
It does. No goodwill, no trademarks, no patents, no brand loyalty, no human capital.
It is a ruthless assumption. I mean, if you apply the intrinsic value method to a massive tech firm or a consulting agency, the resulting value will look absurdly low.
Yeah, because all their value is locked up in software code, patents, and the brains of their engineers.
Exactly. But the asset-based method demands physicality. If a creditor can't seize it and sell it at auction, it does not count.
Let's put this into practice with the first textbook illustration. We have Jet Limited, and they are merging with KP Limited. We need to find the intrinsic value of Jet Limited's shares.
Okay, lay out the balance sheet.
So we have a standard balance sheet. On the asset side, Jet has fixed assets of 1.5 million rupees, investments of 1 million, and current assets of 1.2 million. Total assets equal 3.7 million rupees.
That is the gross pie.
Yep.
Now we have to carve out the external liabilities to find what is left for the equity holders.
We flip to the liability side. We see equity shares of 800,000 rupees. We ignore that, right? Because it's what we are solving for.
Correct.
We see a general reserve of 1 million and a profit and loss account is 600,000.
And we ignore those as well.
Yeah.
As we established, those are internal reserves belonging to the equity holders.
All right. Then we see 9% debentures of 700,000 rupees. And finally, current liabilities consisting of bills payable at 100,000 and creditors at 400,000.
Okay, here we go.
Now, listener, pay close attention here. The textbook's provided solution takes the total assets of 3.7 million, and it only deducts the current liabilities of 500,000.
Wait.
Yeah. It leaves net assets at 3.2 million, divides by the 80,000 shares, and gives an intrinsic value of 40 rupees per share. They completely ignored the 700,000 rupee long-term debentures.
See, this is a classic textbook discrepancy, and it is a massive trap for students. Debentures are long-term debt. They are absolutely an external liability.
They have to be paid.
Exactly. In a true liquidation or a pure intrinsic equity valuation, the debenture holders must be paid out before the common equity holders see a single dime. The liability should have been 1.2 million, which would drastically lower the per-share value to around 31 rupees.
So what is an MBA student supposed to do when they encounter a contradiction like this on a high-stakes exam? Do you follow the strict definition, or do you try to guess what the professor was thinking?
You never guess. You document.
Ah, okay.
The textbook solution likely assumes that the acquiring company, KP Limited, is taking over the assets and assuming the debentures, meaning the debentures aren't being settled out of the net assets at the moment of amalgamation. Or, honestly, it's just a typographical error in the answer key.
Which happens a lot.
Far too often.
Yep.
So when you face this on an exam, you write down a clear assumption. You write, assuming debentures are external liabilities that must be settled, they are deducted from total assets. Then you run the math.
That covers you.
Completely. If you clearly state the underlying mechanism, an examiner will award you the points because you demonstrated mastery of the concept rather than just blindly following a flawed template.
Okay, so intrinsic value gives us our rock-bottom garage sale price.
Okay.
But an MBA student knows you aren't buying a company to liquidate it. You're buying it to run it.
Right, a going concern.
A factory isn't just a pile of bricks. It is a machine designed to print money. So how do we shift our math from dead assets to living, breathing cash flows?
We step into the yield models. The focus shifts entirely from what the company owns to what the company earns, and more importantly, what it distributes.
Got it.
The primary method here is the dividend yield method.
The logic here is incredibly elegant, actually. The textbook formula is value of share equals the dividend per share divided by the industry average dividend per share multiplied by the normal value of the share.
Or simply dividend per share divided by the industry normal rate.
Right.
Let's explore the mechanism of working backwards. If you know a machine spits out $10 a year, and you know that in this specific industry, investors demand a 10% return on their investment.
You can easily calculate that the machine itself must be worth $100.
Exactly. You are taking the cash output and dividing it by the required rate of return to reveal the implied capital base.
The textbook illustrates this with Fatima Limited. They declared 1.2 million rupees in dividends.
Across 500,000 shares.
Right. That is 2.4 rupees per share in pure cash output. And the industry average dividend yield is 18%. So we divide the 2.4 rupees by the 0.18 industry rate.
Because we are asking the math, if 2.4 is 18% of something, what is that something?
And the answer is roughly 13.33 rupees per share.
It grounds the value entirely in reality. There is no guessing about future growth or intangible brand value. It simply asks, based on the hard cash this company pays out and what the broader market expects, what is the fair price?
But corporate finance is rarely that static, is it? What if a company doesn't pay a flat, consistent dividend? What if it fluctuates?
It usually does.
The text gives us the case of Tariqa Limited. Over 5 years, their rate of dividend has climbed steadily, 8%, 10%, 12%, 14%, and 16%. The industry average is 15%. How do we establish a baseline when the target is moving?
Well, an amateur would take a simple average of those 5 years.
Which would just be 12%.
Right. But an MBA student knows that a simple average gives equal weight to a dividend paid 5 years ago and a dividend paid yesterday. In business, recent history is a significantly better predictor of near-term future performance than distant history.
Right. Momentum matters.
Therefore, you must use a weighted average.
Rather than reading out a multiplication table on air, let's look at what the textbook is actually doing here. It assigns a weight of 1 to the oldest year and a weight of 5 to the most recent year. You multiply the rates by their weights, sum them up, and divide by the total number of weights.
And by aggressively weighting the recent years, Tariqa Limited's average dividend rate pulls up to 13%.
Which is higher than the 12% simple average.
Exactly. The weighted average rewards the company for its upward momentum. It captures the trajectory of the business, not just its historical average.
But let's be critical of the dividend yield method for a moment. What if a company makes $1 billion in profit, but the board of directors decides to pay out absolutely nothing in dividends?
Like a lot of tech companies.
Yeah. What if they retain every single penny to build a massive new research facility or to acquire a competitor? Under the dividend yield method, the cash output is 0, so the value of the company is 0. That is obviously absurd.
Which is exactly why the financial world developed the earnings yield method. This method recognizes that a dollar of profit belongs to the shareholder, regardless of whether it is mailed out as a dividend check or retained in the corporate treasury.
Right, because retained earnings are used for expansion, which increases the book value of the shares anyway.
It is still a return on investment.
So the formula shifts from dividends to profits. Value per share equals expected future maintainable profits divided by the number of equity shares. And that phrase, future maintainable profits, is critical, isn't it?
Very critical. You don't just take last year's net income from the income statement.
Why not?
Because last year's net income might include a one-time gain from selling a warehouse or one-time loss from a lawsuit settlement. You have to normalize the earnings.
Smooth out the bumps.
Right. You strip out the anomalies, adjust for expected tax changes, and arrive at a core operational profit number that the business can reliably generate year in and year out.
And as we dive into how to calculate this, we hit another massive exam alert.
Oh, boy.
Yeah. The textbook introduces Jogi Industries. The prompt says, Jogi Industries expects to have future profits of 2.5 million rupees. What is the value of the shares if there are 100,000 equity shares?
Okay, the setup is straightforward. The numerator is future maintainable profits, which is 2.5 million. The denominator is 100,000 shares.
But look at the textbook's solution block. It writes out the correct formula, but then the numbers it plugs in are 5.4 million divided by 100,000, giving an answer of 54 rupees per share.
Right.
Where did the 5.4 million come from? The prompt clearly said 2.5 million.
It is an editorial mistake. An author updated the prompt but forgot to update the answer key.
It's so frustrating.
But again, we discuss this because this exact scenario happens in university exam halls constantly. Professors recycle old questions, tweak a variable, and leave contradictory data in the prompt.
If you are relying on rote memorization and trying to pattern match the textbook, you will panic. You will waste 20 minutes trying to figure out how 2.5 million magically transforms into 5.4 million.
You'll just freeze.
But if you understand the mechanism, you remain calm. You explicitly state your assumptions. You write, based on the prompt stating profits are 2.5 million, the calculation is 2.5 million divided by 100,000 equaling 25 rupees per share.
And boom, you've shown you understand it.
Right. You demonstrate to the grader that you understand the earnings yield mechanism perfectly, regardless of the typographical chaos in the question.
Absolutely. So we have looked at the asset floor, and we have looked at the yield ceiling. The text offers one final method in this section to bridge the gap, the fair value method. And it is surprisingly simplistic.
It really is. Fair value equals the net asset value plus the yield value divided by 2. It is literally just an average.
Yeah.
But from a corporate finance perspective, why average them? What is the philosophical justification for mashing a liquidation price and a going concern price together?
Well, it represents a pragmatic real-world negotiation. The asset value anchors the valuation in physical reality. It ensures you aren't overpaying for pure speculative hype.
Right, the scrap metal.
But the yield value respects the operational brilliance of the company. If you are valuing a heavy manufacturing company, they might have massive assets, but terrible cash flow.
True.
A software company might have phenomenal cash flow, but no hard assets. The fair value method forces a compromise between what capital was sunk into the business historically and what that capital is yielding today.
That makes sense. But let's take that a step further. We've talked about absolute profit and absolute yield, but profit alone doesn't tell the whole story. If Company A makes $10 million in profit and Company B makes $10 million in profit, they look identical on paper. But what if Company A required $100 million of invested capital to generate that profit, while Company B only required $20 million?
Then Company B is infinitely more valuable because its engine is more efficient. And that limitation brings us to return on capital employed, or ROCE. We are no longer looking at raw profit, we are measuring the efficiency of the capital itself.
The textbook outlines the Joida limited illustration to demonstrate this. We have 5 years of data. For each year, we are given the capital employed and the profit.
So the first step is determining the internal efficiency for each individual year. You divide the profit by the capital employed.
And over the 5 years, Joida Limited's rate of return climbs from 15% in 2012 up to 27% by 2016.
Which means the company is actively getting better at squeezing profit out of every dollar invested.
And just like we did with Trika Limited's dividends, we don't use a simple average. We apply a weighted average, assigning a weight of 5 to the 27% return in 2016 and a weight of 1 to the 15% return in 2012.
And this aggressive weighting yields an average ROCE of 22%.
Now we compare that internal engine efficiency to the broader market. The formula is rate of return, so 22%, divided by the market expected rate of return, multiplied by the normal value of the share.
And here we hit another textbook discrepancy to watch out for.
Another one.
Yep. The setup explicitly states the market rate of return is 12%, but the solution calculation suddenly uses 16% as the denominator, dividing 22 by 16 to get 13.75 rupees.
Wait, if they had used the stated 12%, the answer would be 18.33 rupees.
Exactly. The lesson remains consistent. State your assumptions, but focus on the economic logic. If your internal company is generating a 22% return on capital and the broader market is only generating a 12% return, your company is vastly superior.
Obviously.
Therefore, the value of your share must trade at a significant premium to its normal accounting value. The math simply scales the share price up by the ratio of your outperformance.
So we have mastered the past with assets. We have mastered the present with yields and capital efficiency. But an acquisition isn't about buying the past or the present. It is fundamentally about buying the future.
Yes.
You are purchasing a stream of cash flows that will stretch out for decades. How do we accurately value money that hasn't even been printed yet?
Well, this requires a massive shift in our mental framework. We enter the realm of discounted cash flow models, or DCF.
The big one.
The textbook rightly labels this the most reliable and commonly used model in corporate finance. It is the gold standard for investment banking because it bypasses accounting fictions like depreciation and amortization and focuses strictly on actual cash.
To understand DCF, you have to internalize the core limitation of future money. Like if a company promises to hand you $1 million 10 years from today, you would never pay $1 million for that promise right now.
Definitely not.
Because if you had $1 million today, you could invest it in treasury bonds and earn interest for 10 years. Therefore, future cash must be discounted back to present value.
And the severity of that discount depends entirely on the risk of the business. That discount rate is called the weighted average cost of capital, or WACC. It is the blended cost of the company's equity and debt.
Let's expand on the real-world application of WACC, because this dictates corporate strategy. Why is WACC a weighted average? Why is debt generally cheaper than equity?
Well, it comes down to tax shields.
Right.
When a company pays interest on a bank loan or a bond, that interest expense is deducted from their operating profit before taxes are calculated. The government is effectively subsidizing the company's debt by lowering their tax bill. Dividends paid to equity holders, however, are paid after taxes. Because of this tax shield, adding debt to a company's capital structure will mathematically lower its WACC.
Which means the discount rate drops and the present value of future cash flows goes up.
Exactly.
This is why private equity firms use leveraged buyouts. By loading a target company with debt, they lower the WACC, instantly increasing the theoretical value of the future cash flows.
It's engineering value.
But you can't just project cash flows year by year until the end of time.
Right, that would take forever. You project explicit cash flows for a specific period, say 5 or 10 years. After that, you calculate a terminal value.
Which is what?
It represents the value of all cash flows from year 11 to infinity. The textbook uses a variation of the Gordon growth formula for this, the cash flow of the first terminal year divided by the WACC minus a constant perpetual growth rate. You then discount that massive terminal value lump sum back to the present day.
The text mentions variants like the discounted dividend method, which discounts expected dividends by the cost of equity instead of WACC. But I want to spend our time on the most crucial MBA concept in this entire section: discounted economic value added, or EVA.
Oh, EVA is a phenomenal metric. It ruthlessly exposes value destruction. Traditional accounting tells you if a company made a profit. EVA tells you if that profit was actually worth the capital required to generate it.
Let's look at the textbook formula for EVA. It's NOPAT net operating profit after tax minus the product of capital and WACC. Let's upgrade our previous analogies to fit a corporate M&A context. Imagine Amazon decides to launch a brand new hardware division to build smartphones.
A risky move.
Very. They pour $1 billion of capital into this new division. And let's say Amazon's overall cost of capital, their WACC, is 10%.
That means the capital charge on this division is 10% of $1 billion, which is $100 million.
Right.
Amazon's investors demand at least $100 million in return just to cover the cost of the funds used.
Exactly. Now, at the end of the year, the new smartphone division reports a net operating profit after tax of $80 million.
Right.
The PR team puts out a press release. Wall Street might even cheer because the division is technically profitable, right?
Yeah.
It generated positive cash flow.
But under the lens of EVA, we see the dark truth. NOPAT, which is 80 million, minus the capital charge, which is 100 million, equals a negative 20 million.
The division destroyed $20 million of shareholder wealth.
Unbelievable.
Even though they made an accounting profit, their return on capital employed, which was 8%, was lower than their WACC of 10%. They took $1 billion that could have earned 10% elsewhere and only earned 8% on it.
The textbook provides an alternate formula that beautifully illustrates this. EVA equals ROCE minus WACC multiplied by capital.
This is why EVA is the ultimate truth serum for corporate managers. The total value of a business under this model is the capital invested PLUS, the present value of all future EVAs.
Yes.
If a company has massive assets but consistently generates negative EVAs, its true enterprise value is actually lower than the book value of its capital. The aggregate of those future EVAs is called market value added.
So DCF and EVA require us to aggressively discount future cash based on risk. But how do we objectively determine what that risk is?
Yeah, how do we calculate the cost of equity?
To answer that, we must leave accounting behind and enter the realm of academic financial theory.
We have arrived at the theoretical heavyweights.
The big ones.
These are the Nobel Prize-winning models that form the bedrock of modern finance. Let's start with the dividend growth technique, widely known as the Gordon growth model.
The premise is that the value of a share is simply the present value of an infinite series of growing dividends.
Okay.
The formula is value equals current dividend multiplied by 1 plus the growth rate, all divided by the cost of equity minus the growth rate.
So D, 0 times 1 plus G over KE minus G.
Exactly. It's an incredibly elegant formula, but its assumptions are fiercely rigid. It assumes a constant rate of return, a constant cost of capital, and no taxes.
But the most critical assumption, one that will break your valuation if you ignore it, is that the cost of equity, KE, must be strictly greater than the growth rate, G.
Right. Let's discuss exactly why the math breaks down when growth outpaces the cost of capital. Let's look at the dot-com bubble in 1999.
Oh, perfect example.
You had tech startups with a required return of 15%, but analysts were projecting perpetual growth rates of 30% or 40%. What happens when you plug a 30% growth rate and a 15% cost of equity into the Gordon growth denominator?
Well, you get 0.15 minus 0.30, which gives you a denominator of negative 0.15. You are dividing a positive dividend by a negative number, resulting in a negative share price, which is physically impossible.
Right.
Or, if the growth rate exactly equals the cost of equity, your denominator is 0, which implies the stock has an infinite value.
And that mathematical breakdown reflects a philosophical reality. No company can grow faster than the overall economy forever.
It's just not possible.
If a single company maintained a 30% growth rate into infinity, it would eventually become larger than global GDP. It would literally swallow the universe.
So if you were asked to value a hypergrowth startup on an exam, you cannot use a single-stage Gordon growth model. You must explicitly state its limitation. It is only valid for mature, stable companies with a sustainable, moderate growth rate.
Next in the theoretical pantheon is Walter's valuation model. James Walter challenged the idea that dividend policy is just an arbitrary decision by the board. He argued that dividend policy and investment policy are inextricably linked.
Walter's formula balances the dividend payout against retained earnings, but it is entirely driven by the ratio of two key metrics: RA, the internal rate of return on the company's investments, and RC, the market's cost of capital.
The exam takeaway here is understanding the battle between reinvestment and payout.
Right.
If RA is greater than RC, the company is an exceptional wealth compounder. It can take $1 and generate a 20% return internally, while the shareholders can only get 10% in the open market.
In that scenario, what is the rational desire of the shareholder? They want 0 dividends.
None at all.
They want the company to retain every single penny and aggressively reinvest it. Conversely, if RA is less than RC, meaning the company is terrible at allocating capital, the shareholders demand a 100% payout ratio.
Give us the cash so we can invest it better ourselves.
Exactly. Walter proved mathematically that the optimal dividend policy is a direct function of internal capital efficiency.
But then we reach the most controversial theory in the textbook, Modigliani and Miller's dividend irrelevancy model, the approach.
The bombshell.
Oh, they dropped a bomb on corporate finance by asserting that in a perfect world, a firm's dividend policy has absolutely 0 influence on its overall share value.
0 influence. This contradicted decades of investor sentiment that prized high dividend stocks. The intuition behind is best explained with the $10 bill analogy.
Let's hear it.
Imagine you hold a $10 bill, which represents the total value of your share in a firm. The company declares a dividend. They take your $10 bill and they hand you back 2 $5 bills. One $5 bill is your remaining share value. The other $5 bill is your cash dividend.
So the critical question is, did that transaction create any wealth? Are you any richer?
No. You still have exactly $10 of total wealth. The pie didn't expand, it was just sliced differently.
Right.
Argued that value is driven entirely by the left side of the balance sheet, the operating assets, and their ability to generate cash. How you distribute that cash on the right side of the balance sheet is irrelevant to the enterprise value.
However, we have to push back on this
Yeah.
because an MBA student knows the real world is not an perfect vacuum.
Exactly. Consider Apple. Apple sat on a massive pile of cash for years. When they finally announced they were initiating a dividend program, their stock price surged.
It did.
If Modigliani-Miller are perfectly true, the stock price should have simply dropped by the exact amount of the dividend, resulting in a net zero wealth change. Why did it jump?
Well, because of signaling theory and taxes. In the real world, dividends carry information. A board of directors committing to a permanent cash payout signals immense confidence in future, sustainable cash flows.
And the real world has taxes and transaction costs.
Exactly. Is vital not because it perfectly describes reality, but because it provides the theoretical baseline. It forces you to isolate operations from financial engineering.
The final theoretical model we must conquer is the capital asset pricing model, or CAPM. This is how we actually calculate the discount rate that we use in our DCF models. CAPM determines the required rate of return by rigidly defining the relationship between risk and reward.
The genius of CAPM is separating risk into two distinct buckets: unsystematic risk and systematic risk.
Okay, let's break those down.
Unsystematic risk is firm-specific. It is the risk that a specific CEO makes a terrible acquisition or a single factory goes on strike.
But the market does not compensate you for unsystematic risk. Why? Because you can easily eliminate it through diversification.
Right.
If you hold a portfolio of 500 different stocks, one CEO's bad decision doesn't ruin your portfolio. Therefore, the market will not pay you a premium for taking a risk you could have easily avoided.
The risk the market does compensate you for is systematic risk. This is macroeconomic risk. A global financial crisis, a spike in inflation, a sudden hike in federal interest rates.
You cannot diversify away from a recession. It hits everything.
Therefore, investors demand a premium to endure it.
And we measure that systematic risk using beta. Beta is a metric of volatility relative to the broader market. If the S&P 500 drops 1% and your stock drops exactly 1%, your beta is 1.0. You move in perfect lockstep with the market.
But if the market drops 1% and your stock plummets 2%, your beta is 2.0. You are twice as volatile and twice as risky.
The textbook illustrates the CAPM formula with gamma limited. The formula is expected return equals the risk-free rate PLUS beta multiplied by the market risk premium.
And the risk-free rate is your baseline, usually a 10-year government bond. The market risk premium is the extra return the overall market historically generates over that safe bond.
So for gamma limited, the prompt tells us the risk-free rate is 12%. The expected return of the market portfolio is 18%, and gamma's beta is 1.50.
So we calculate the market risk premium. 18% market return minus the 12% risk-free rate gives us a premium of 6%.
Right.
We multiply that 6% premium by gamma's beta of 1.5, which equals 9%. Finally, we add that 9% risk adjustment back to our 12% risk-free baseline. The result is 21%.
That 21% is the cost of equity. Because gamma limited is 50% more volatile than the market, rational investors demand a steep 21% return to hold the stock. You now have the exact discount rate to plug into your Gordon Growth or DCF model.
We have survived the academic gauntlet.
And we made it.
But as any investment banker knows, when you are in the middle of a fast-paced M&A negotiation, you don't always have the time or the perfect data to build a 10-year DCF model using CPM discount rates.
But sometimes you need a reliable shortcut.
Which brings us to our final methodology, valuations based on fundamentals, universally known as multiples.
Multiples.
This is relative valuation. You take a specific financial metric of your target company, and you multiply it by a factor derived from how similar companies are currently being priced in the open market.
The textbook highlights the operating profit multiple, specifically enterprise value to EBITDA, earnings before interest, taxes, depreciation, and amortization. Why do we use EBITDA instead of net income for an enterprise value multiple?
Because, as we discussed earlier, enterprise value is capital structure neutral. It represents the value of the assets independent of how they are funded. Net income is calculated after interest expenses are deducted. If you use net income, a company with heavy debt will look less profitable and therefore less valuable than an identical company with no debt.
I see.
EBITDA strips out the interest expense and the non-cash accounting fiction of depreciation, giving you a clean look at the operating core.
Another deeply trusted multiple is the operating free cash flow multiple. This takes EBITDA and subtracts capital expenditures and changes in working capital. It is revered because cash is indisputable fact.
Cash is king.
You can manipulate accounting profit, but you cannot manipulate the cash sitting in the bank account after you've paid for your factory upgrades.
But the textbook also introduces the revenue or sales multiple, enterprise value divided by total sales.
I have to challenge the logic of this one. Why would an acquirer ever value a company based purely on its top-line sales, especially if the company is actively losing millions of dollars on the bottom line?
That's a fair question.
Paying a premium for a money-losing operation seems irrational.
It seems irrational until you apply it to the context of land grab strategies, particularly in the tech sector. Think about early-stage software companies or massive e-commerce platforms.
Oh, like Uber or Amazon early on.
Exactly. They might be intentionally running massive deficits because they are spending aggressively on customer acquisition. They are trying to achieve a monopoly.
Ah, so the sales multiple isn't valuing current profitability, it is valuing market share.
Right.
The acquirer is betting that once the company secures a dominant scale, they can turn off the marketing expenses, raise prices, and those massive sales will violently swing into massive profits. The multiple is a proxy for future dominance.
Finally, we have the price-to-book value multiple, or PBV. It compares the market's price of the equity to the adjusted accounting book value.
This perfectly closes the loop of our entire deep dive. Book value is directly linked to the conservative asset-based intrinsic valuation we started with.
Full circle.
The PBV multiple simply asks, how much of a premium is the market willing to pay over the physical scrap value of the assets? If a company trades at a 5x price to book, the market is screaming that the company's value lies in its intangibles, its brand, its patents, its operational efficiency things the intrinsic model ignored.
So, as you prepare to walk into that exam room, the most critical skill you can possess is contextual awareness. The formulas are useless without knowing when to deploy them.
If the prompt describes a liquidation or a baseline asset transfer, you deploy the intrinsic garage sale method. If it describes a stable, mature firm paying out cash, you pull out the yield models.
Right.
If you are asked to value complex future cash flows or prove whether management is destroying capital, you wield DCF and EVA. And if you need to price a rapid M&A deal based on current market sentiment, you use multiples.
Do not panic when the professor changes an assumption or a number contradicts itself. Fall back on the economic logic. Explain why you are deducting external liabilities or why you are weighting recent years more heavily. State your assumptions clearly.
I want to leave you with a final provocative thought that builds on all this rigorous mathematics. We have just spent an hour dissecting highly precise Nobel-winning formulas. We have calculated WACC down to the decimal point and defined beta.
We did a lot of math.
But here is the stark reality of corporate finance. In almost every major merger or acquisition, the buyer's investment bankers and the seller's investment bankers will use the exact same historical data, the exact same DCF models, and the exact same CAPM formulas.
Oh, I know where you're going with this.
And they will arrive at valuations that are hundreds of millions, sometimes billions of dollars apart.
If the math is truly absolute, that massive divergence should be impossible.
It raises the ultimate question. Is business valuation truly a mathematical science governed by objective laws? Or is it, at its core, the art of persuasive storytelling, heavily disguised in the costume of complex algebra?
That's a great question.
Are we using these formulas to discover the truth? Or are we manipulating the discount rates and growth assumptions just to mathematically justify the story we already want to tell the board of directors?
That is the real dark art. The math simply sets the boundaries of the debate. The narrative dictates the final price.
Keep that tension in mind as you study. You aren't just memorizing formulas, you are learning the vocabulary of financial persuasion. Good luck crushing that corporate finance exam. Keep questioning the mechanisms, and we will see you on the next deep dive.